Hello again, everyone. My name is Cheryl Corbett. I'm a partner in the business department at Tonkon Torp, a full-service business law firm in Portland, Oregon, and I am today's moderator. Welcome to our webinar, To Sell or Not to Sell, M&A Perspectives in Late 2020 and Beyond. Our hope is to provide you with an overview of current market conditions and practical advice on how PPP loans may impact any merger and acquisition transaction. Today, you will hear from 4 of our panelists. Brian Murphy, President and Managing Director at Meridian Capital, a Seattle-based middle market capital sourcing and mergers and acquisitions advisory firm. Next, you'll hear from Claire Brown and Drea Schmidt, both experienced partners in Tonkon Torp's business and M&A department. And last, you'll hear from Tim Conway, an experienced partner in Tonkon's bankruptcy department. Before we get started, let me pause and tell you a little bit about this Zoom format. This webinar format allows you to ask questions. Feel free to submit them in the Q&A section of your Zoom app. I will do my best to ask each panelist a few questions as they come up during their presentations. But we want to be sure to have time for all of the panelists. So if I don't ask your question right away, please wait for the end. We will conclude with a Q&A session and we'll try to hit as many questions as we can in the hour. Please also note that we are recording this webinar. You do not need to sign a disclosure and no private information of yours will be shared. But please know, however, that should you choose to participate in our Q&A section, your question may be recorded in association with your name. Note that the information presented today is as of October 15th and is not intended to be legal advice. And finally, we welcome any feedback you may have after this webinar. If there are any other topics you want to hear about, please let us know. We hope to be a source of information for our business community throughout these challenging times and plan to hold additional webinars going forward. So now, with all of our formalities out of the way, I will turn it over to our first panelist, Brian Murphy. He'll provide an overview of the current market conditions for mergers and acquisitions. Brian, can you tell us how COVID has impacted the M&A market, what you're currently seeing in the market, and what are the key considerations for business owners?
Thanks, Cheryl. I appreciate the opportunity to be here and always appreciate partnering with Tonkon. I thought you might ask that question, so I prepared some slides for the group. Hopefully the group can see those as they've come up. But just to give people some perspective, as Cheryl mentioned, Meridian Capital is an M&A advisory firm located in Seattle, serving business owners, entrepreneurs, and family businesses throughout the Pacific Northwest. So the context of our feedback typically has to do with what is going on in the private lower middle markets and how are business owners and investors responding to the current M&A trends, both immediately post-COVID and now as we're 6-8 months into the pandemic. My presentation or comments will really fall into 2 key topics to address the question Cheryl answered. First, what is going on in the M&A markets and what's been going on in the last 6 months? And then 2, based on those dynamics or trends, what are we seeing some of our clients and our investors do to respond and react to those trends? First, what's going on in the capital markets at a high level? So it has been an extremely dynamic 6 to 8 months due to the ongoing COVID crisis. Beginning in March and April, right after you saw some of the shutdown, there was essentially a halt in all middle market private transaction activity. The private markets move a little bit differently than the public markets. Public markets have the benefit of a lot more stimulus, a lot more visibility, larger companies, different investor group. Private markets and smaller markets of sub $500 million transactions are very much impacted by lack of visibility and uncertainty, 2 things that there was an abundance on earlier in the year. What has been very interesting is despite deal volume being down 25% through the first 6 months of the year, and that number I'd say is even a little misleading because transaction activity was actually up through Q1, and so that 25% is really a pretty meaningful number when you think they're up through Q1 and then down year to date. M&A markets have returned to near record activities over the last 60 to 90 days in terms of new opportunities coming to market. and capital providers looking to put money to work. So when we speak to our peer group and we speak to our potential clients or businesses we cover, the number of individuals looking to seek capital solutions or come to market is truly at record levels compared to the last few years. What is driving this? From a capital availability standpoint, there is still, just from private equity and venture capital firms alone, and I'll show you the graph in a bit, there's about $2.5 trillion of available private equity money that by definition needs to be put to work in the market. Lenders and debt providers, which provide about half the capital for these middle market transactions, after really leaving the market in Q2, although they've returned to the market at slightly lower levels, they're back to lending capital. And the stimulus funds, although everyone has opinions on maybe the regulation and how easy the administrative processes of work, the amount of stimulus money coming into the market has provided a significant bridge for a lot of private companies to either make it through a challenging time, or in many cases for companies that maybe took on a PPP loan, but were able to maintain their cash flow position. It provided funds to pursue growth opportunities, including acquisitions. The investor response and seller response has been interesting as well. Investors, now that they've come back to the market, they've very much narrowed their investment criteria. So we very rarely talk to groups anymore that say, hey, I'm just generally looking at industrials, or I'm generally looking at technology. Given the amount of capital in the markets and the uncertainty, we've seen a flight to groups really focusing on the areas that they know best, focusing on the type of structures that they're most comfortable with, in order to really, in times of uncertainty like this, investors will really, you'll see flight to the industries they know best. So we've seen narrowed investment focus. So the days of maybe including 100 or 200 people in a process that we run are gone. We tend to go to 30 or 40 groups now that are most well aligned with an industry. And you'll see, and I know Claire and Andrea will speak to this, we're seeing investors, although respond pretty favorably in terms of ongoing valuations, they're pushed to increase the risk allocation to the sellers to deal with ongoing COVID risk or ongoing PPP forgiveness uncertainty. There's been a change in risk allocation, which I know the group at Tonkon will discuss later. Sellers' response has been very interesting. Again, we deal a lot with private owners where a meaningful portion of their net worth and personal identities in many cases are associated with the businesses they run and own. So when you have a period where the markets are rattled and there's a lot of uncertainty, but then there's a recovery, it often has a lot of people reassess about how long they want to be owning their business, or whether or not they'd like to take some chips off the table or see some liquidity. And between that and perception that the tax law changes could change in the upcoming election over the next 12 to 24 months, we're seeing a lot of business owners come to us and say, with this growing uncertainty, this growing execution risk, with what's happened to some of my friends that maybe own businesses in the restaurant space or the retail space, and the pending capital gains tax changes, maybe it's time for me to consider some of my options. I mentioned the capital overhang here on the next slide. This just shows over the last 5 years, there's been record fundraising activity for private equity funds. And these private equity funds, by definition, are put back into private markets and purchasing privately held businesses. So with 5 years of record activity, it's built to a $2.4 trillion overhang or available capital. What's happened over the last 6 months in a slowdown of M&A activity, that capital by definition was not able to be put to work, but it needs to be put to work within a 2 to 4 year time frame in order to adhere to the investor promises that these private equity firms have made to their investors. So what that means is after a 6-month delay, there's a lot of pressure from these private equity firms and this $2.4 trillion to be put into market in some way. And that has continued to drive activity. And as a result, something very interesting has happened year to date with respect to valuations. As you can see from this graph, after the recession in 2008, 2009, when valuations dropped. You've seen a gradual climb in average valuations over the last 10 years, 10 to 12 years. And you've seen a gradual increase in transaction activity as well, peaking over the last 3 to 4 years in record M&A activity. Early in the year, if you had asked us in March, we would have said there's going to be a significant drop in valuations this year, given uncertainty. But what you've actually seen is a drop in transaction volume, but the average valuation actually has increased year to date through June. And what's happening is companies that, such as technology, such as e-commerce, such as defense, such as food and beverage, have continued to perform well and come to market. And you have less deals in market being chased by still a record amount of capital, which is keeping valuations high. So what does that mean in terms of what we expect to see in Q4 in 2021? I will say these opinions are with the heavy caveat is we don't know what's going to happen in the election, and we don't know what's going to happen with COVID over the next 6 months. But assuming that there is no shock to the market, given the perceived risk, again, of capital gains law changes, given the perceived increase in execution risk in the market over the next 18 months, business owners having less certainty of how their business will perform, and the ongoing strong availability of capital and strong valuations, we believe that 2021 has the potential to be one of the strongest M&A years in history in terms of number of deals completed. We think that it'll be very much a bifurcated market. So you'll see, again, sectors that are well aligned with current risks in the market, such as software, such as tech-enabled services, food and beverage, defense, doing very well. Some of the more general industrial, traditional restaurant and retail that maybe have less certainty will continue to see challenges, and will likely see more distressed sales than anything else. Also, we will see that increase in minority and structured equity transactions. And what we mean by that is over the last 5 years, most transaction activity has been led by the baby boomer generation looking for full liquidity or almost full liquidity. Given what's going on today, we think there'll be more minority transactions, business owners looking to get some liquidity, but continue to see upside in the business, a younger selling shareholder, leading to more flexible transaction structures. I mentioned it before, and again, the Tonkon team will discuss in more detail. Although there will be a lot of transaction activity, it will likely be harder than ever to get deals done, given the increase in due diligence, legal considerations, and unique challenges caused by the current pandemic and COVID. Quickly, what does that mean for business owners if they don't want to sell their entire business today? There are several options available to our clients when we speak to them. Again, these are clients that are looking to capitalize on currently attractive capital gains rates, put some money aside in a nest egg to reduce their risk profile if the pandemic has meaningful impacts in 2021, or raise capital to pursue acquisitions. I won't talk a lot about the left-hand side, the bridge financing and senior debt. These are traditional loan instruments that I imagine many of you are familiar with. You get them from a Wells Fargo or B of A or JP Morgan Chase. The right-hand side of the screen, starting with the sub-debt, moving to capital raises and structured equity and recapitalizations, are what we call the alternative equity or alternative financing universe. These are the solutions that we're having a lot of conversations with our clients today. These are solutions that in all cases allow business owners to maintain a significant portion of the equity or ownership upside in the business, get access to increasing amounts of capital compared to traditional lending, and provide more flexible structures than a senior debt or traditional banking facility would have. As you move to the right, each one of these solutions have a higher cost of capital, meaning they have higher interest rates, or since you're giving up equity, they have higher cost of capital because that equity hopefully will grow into the future. And so it dilutes ownership. But very interestingly, all these mechanisms, they don't have any amortization. So when you take a $10 million loan from the bank is going to want you to pay usually about 20% of that loan off per year, or $2 million. These other solutions give you access to more capital. They charge higher interest rates, but they don't charge any amortization, meaning you have more capital available to grow your business. So for those business owners looking to take out liquidity to capitalize on current capital gains, to again, make acquisitions, or to just strengthen their balance sheet. These are often viewed as attractive solutions, particularly if the money is going to be put to use growing the business, because again, the cash flow considerations are often advantageous. There's lots of different structures related to these, lots of different guaranteed returns, but I would encourage anyone on the call that is thinking about a capital solution, needs more than their traditional lender is able to give them, but does not want to sell their company, to talk to their attorney, their financial advisor, their investment banker about which one of these options might best align with their shareholder goals. The last item I'll touch on is, we've talked about what's going on in the M&A markets. We've talked about some of the options available to business owners. But as Cheryl said, what are some of the considerations that we are recommending that our clients look into? One is preparing for a transaction early. Again, Claire and the Tonkon team will go into a lot about what that means from a legal and organization perspective. What we talk about at Meridian is, what steps can you take to be prepared if an opportunistic or if an unsolicited opportunity or an unforeseen opportunity comes to you out of the blue. So are you aware what financing is available to you? Are you aware how investors will look at the value of your business? Are you aware how the overall capital markets will look at the value of your business? These are questions and things that we think are important to consider, so you can more opportunistically capitalize on capital opportunities when they come to you. Timing considerations, when you look at this, again, we believe 2021 will be a very attractive year for sellers to come to market given valuations, but ultimately your shareholder liquidity goals and your post-transaction goals are most important in determining which timing is right for you. What I mean by post-transaction goals is, are you a business owner or a management team that wants to stay in the business, or are you looking to transition out? That has a major impact on the options available to you. How much business visibility and execution risk do you see in your business over the next 18 to 24 months? If the execution risk is very high and you believe capital gains rates are going up, it's likely a good time to at least see if some liquidity is a good option for you. What unique diligence concerns do you have available today? If you have unique environmental concerns, unique employee retention concerns, items such as that, very important to get those cleaned up or at least addressed prior to coming to market or having capital market conversations. And then lastly, what visibility you can give in terms of succession or management transition strategy to any incoming investor. That is key to timing as well. So again, there's unique considerations around each one of these points, but these are the items when we talk to our clients, they should be thinking about when determining what's the right timing and what transaction structure is right for them. So with that, Cheryl, I'll kick it back to you, and happy to answer any questions at the end.
Great. Thanks, Brian. Surprisingly upbeat for the outlook, considering what we're all going through right now, but that's good to hear. So that's a good segue into Claire's presentation. She's going to help us address how a company can position itself to be a target and go through the transaction efficiently and minimize those roadblocks and challenges that Brian was talking about that might prevent a sale from actually occurring. So Claire, can you tell us a little bit about what enhanced buyer due diligence sellers can expect in these times? In addition to all the ordinary course diligence, I tell my clients when they're sellers that the buyer is going to look at your financials, your contracts, intellectual property ownership, employment matters, environmental, but what else could sellers do in preparation for a review by a buyer in 2020 and 2021?
Great, thanks, Cheryl. Yes, we are expecting that due diligence, which is the process where the buyer gets all of the information it feels like it needs about the seller and its business, including any follow-up questions or additional information, which is always kind of a painful and lengthy process and takes a lot of time and energy on the company's side and on their advisor's side. Their financial and legal professionals on both sides review this information that's provided. We're expecting a much deeper dive into all of the ordinary diligence items and also the addition of new diligence items that we haven't really seen in the past. This translates into higher transaction costs, more management time, more employee time, more legal time, and that will increase the time to close and also the cost of the transaction for both sides. The way to get out in front of this is to be prepared to give the buyer what they're asking for and to address any follow-up questions quickly and without then spurring even more questions. So I also expected this, so I have a slide here with a list of some of the things that I think are worth talking about. So I'm not going to spend any time on the stuff that we always provide. Instead, I'm just going to try to highlight some of the differences that we're expecting for the rest of this year and all of next year. First, along with the ordinary financial information, sellers can expect buyers to push pretty hard on things like adjustments or assumptions in their financial statements. Sellers should be ready to justify any choices they've made about the information they're presenting. Also, sellers likely will have not only a 2020 budget, but a 2020 revised budget that they probably did in March or April, and also a 2020 actual. And the differences between those three documents are going to spur some pretty serious conversations in a lot of cases. So be prepared to talk about if those three are different from each other, why, and how that affects the way that the buyer should think about the company going forward. Financial projections are going to be interesting. Sellers usually put together their own model for financial projections that's part of their package that they deliver to buyers or potential buyers that says how the company is going to perform in the future and gives information about the assumptions underlying that assessment of future performance. Some buyers have always taken the position that they need to provide their own model, so they'll kind of build their own financial projections from the ground up. We think that's going to be a lot more common. And what that means is that sellers are going to have to provide underlying data for the projections rather than the projections themselves. This will probably be a lot more work and will spur a lot more questions. So back and forth with the buyer as they try to draw their own conclusions about what assessment of the future performance of the company is appropriate. At the same time, buyers will not only be trying to assess the company's potential future performance, but the state of the world. Not only when will the pandemic end, but what will the world look like when the pandemic ends? Making those sorts of value judgments about what's going to be different. It's just not really a return to normal. It's some sort of new reality, and we're not really sure what that looks like yet. So there's a few different types of assumptions and guesses that are going on. And that ties into sellers, will share with buyers their strategic plan. And there's going to be some interesting, there's just so many assumptions. There's going to be some interesting conversations about whether the seller's assessment of the company's future and what choices the company is going to make in the near term and long term are appropriate or knowable, or what sort of discount needs to be applied. All that sort of stuff is going to be the subject of, we think, a lot of conversations and a lot of back and forth. With respect to the legal work, the contract diligence part of the transaction always takes a lot of time because both legal teams spend kind of a long time looking at all the legal agreements that the seller has in place. There are always a few things that we focus on, however, and we think that list is going to be longer. For example, I don't think I've ever really been directed by my client to spend a lot of time thinking about force majeure clauses. And now lawyers are going to think really hard about whether the force majeure clause in an important contract has been invoked by COVID and whether that modifies either party's obligation. Same thing when it comes to whether an amendment has to be in writing, or whether a contract may have been amended by course of dealing, whether a party waived certain rights under the contract and whether that affects the contract going forward. Those are not ordinarily part of due diligence, and we think they will be going forward because they could very meaningfully affect the value of a contract to the buyer. Also, rather than just assessing the strength of a contract, buyers are probably going to push their diligence review into the strength of the counterparty. Depending, I mean, and this will be kind of idiosyncratic, but it might be the case that it's not enough for a contract to be pretty airtight if the counterparty is itself facing some, post-COVID new reality risk, or is reliant on, certain supply chain issues, or, I don't know, the post office staying efficient and that sort of thing. So those sorts of counterparty reviews and deep dives into the supply chain of a seller, if it has one, if it's dependent on one, we think are going to be a lot more common. There are also some kind of new risks that we haven't seen before, and Brian touched on a few of these. There are potentially pretty wide swings in some regulations, tax laws, environmental regulations, depending on how this next election goes. So, thinking about how that one or the other is going to potentially affect a seller is going to be pretty interesting. And then a risk associated with an employee pool that is kind of new is, can the employees work remotely? Are they working remotely? Do they have to be there in person? Heavy industrial companies, are going to have a different risk profile in terms of their employees than a software company. So we think that is going to spur some questions. And then there are, debt issues. There've been a lot of, not only my partner Dre is the expert on PPP loans, which is obviously part of this, but forbearance or excuse from compliance with covenants might have been part of this recent, few months. And is that going to be true going forward? And we're also expecting that buyers who always expect to, often expect to pump cash into a company to kind of carry out the plan after the transaction, they're probably going to want a bigger cash cushion. Just if the pandemic stretches on, if some of the assumptions were not correct, because they're making all sorts of assumptions, that sort of thing. So the cash needs of the business is going to be a little bit of a different conversation than it has been in the past. So Cheryl, all this is a way to say due diligence is going to be longer, time to close is longer, and it's probably going to be more expensive.
Thanks, Claire. So once we get through the due diligence phase with a seller and a buyer, can you tell us a little bit about what to expect in the negotiation of the purchase agreement? I know that, Brian mentioned that although valuations are up, there's sort of a new risk profile now in this COVID era in negotiating those kinds of terms in the acquisition agreement. Can you talk about that?
Certainly, yeah. I totally agree with Brian. I think we're going to see more risk sharing or outright risk shifting where the parties, decide to support the higher valuation. One of the other levers that a buyer can pull is by making the seller continue to stand behind some of the things that they've assumed or promised about the company. So this can take the form of a bigger escrow, a pool of money that's there to satisfy any indemnification obligations that the buyer might have. Special indemnities, Brian mentioned this one, but a lot of buyers are not eager to take on any risk related to a PPP loan, for example. They want to leave all of that with the seller. Other specific risks, like the things I just talked about things that are might be idiosyncratic to a company or an industry, but that the buyer might want the seller to keep all of the risk associated with it. Also, sharing in the future growth of the business, either through an earnout, which involves holding back part of the purchase price and only having it payable if certain contingencies are met, usually related to performance, but maybe also renewal of a contract or something like that. We think there's going to be greater reliance on those, and also potentially keeping the seller with some skin in the game, even in a sale context. And Brian talked about the ways that a seller can get liquidity without actually fully selling the business. And this is a little more towards that flavor, but rolling over and having the sellers become equity holders of the buyer in order to keep their interests aligned and their success kind of rising and falling with the post-closing performance of the company. So Cheryl, I think those are a few things that sellers can definitely expect.
Thanks, Claire. We have some questions for you on this topic, but I'm going to hold them till the end so we can get to Drea. Drea will talk to us about the PPP loans and how they impact M&A transactions. It's a unique issue these days because we haven't had to deal with this in the past. It's all COVID specific and related. And many of our clients have taken out these loans, and many of you attending probably have too. They're starting to come up though in deals on a regular basis, and especially in light of the fact the SBA has recently come out with some guidance on how you're supposed to handle these things in an M&A transaction. So Drea, can you talk about where most borrowers now stand in terms of the forgiveness piece of it and how PPP loans are impacting M&A transactions?
Yeah, absolutely. So as you mentioned, Cheryl, PPP is new for all of us. And I think, as I suspect a lot of folks on the call have PPP loans or have familiarity with the process. And what's been happening is we've just had to continue to evolve and transition with respect to figuring out how are you going to deal with these loans. And the same thing is true for dealing with these loans in the context of an M&A transaction. So at this point, the applications for new PPP loans for this round are closed. Many borrowers have already spent their funds and they've completed their covered periods, and they're now moving to the point where they're looking to apply for forgiveness. We initially expected that lenders would begin starting to accept forgiveness applications back in July, but here we are now, it's the middle of October, and many PPP lenders have only just begun to start taking forgiveness applications. And there are others who are starting to get ready to open their forgiveness portals now over the next few weeks. I will say I'm aware of a number of PPP borrowers who have been able to submit their forgiveness applications. And I just heard at the end of last week from a regional bank that they received approval of their forgiveness applications on 2 of the loans that they had submitted to the SBA for approval of the forgiveness. So it seems like things are actually starting to move, which is great. But it's just a much slower process than we expected. So of course, virtually all PPP borrowers are looking to get these loans forgiven and off their books sooner rather than later. But this is particularly true for any borrower who is either in the midst of a sale or anyone who is thinking about selling in the near future. I'll talk a little bit about this in more detail in a minute, but an outstanding PPP loan definitely increases the amount of complexity in a transaction, and the ability to submit your application for forgiveness will be key for determining the timeline on your loan. So with that, I'm going to talk about 4 specific issues that PPP borrowers need to be thinking about in the context of an M&A transaction. So specifically, I'll talk about the treatment of the loan in the deal, what we're seeing in terms of how these loans are being dealt with. We're going to talk about required consents from your PPP lender and the potential for a required SBA consent and how that's going to affect timing. It's going to be really key. We'll also talk about what we're going to expect with respect to buyer diligence on PPP loans. As I think both Brian and Claire mentioned, buyers are not interested in taking on a lot of risk at this point, so that's going to be significant. And I will just touch on the treatment of your PPP loan in the purchase agreement. So first, I think for a lot of folks, it's going to be of primary interest to understand whether, as a borrower and a seller in a transaction, whether you are going to be able to take advantage of the forgiveness of your PPP loan. Obviously, I think sellers want to be able to take advantage of that forgiveness. It was one of the primary reasons for taking out these loans. But the reality is that in the transaction, this is going to be a point of negotiation between the buyer and the seller. And so we have seen some buyers that are really not interested in dealing with the hassle of a PPP loan, and they don't want to touch the PPP loans, and they are just requiring that loan be paid off at closing along with any other debt. So that's one potential position that a buyer could take. And unfortunately, in that case, the seller loses the benefit of having their loan forgiven. But the other common structure that we have seen is the use of an escrow account. And the way that would typically work is that the seller will deposit the full amount of the PPP loan into an escrow account. And then that typically would be released, that amount would be released typically to the seller upon forgiveness of that loan. And that structure allows the seller to benefit from the possibility of having the loan forgiven, but it also puts the risk on the seller for the possibility that that loan ultimately will not be forgiven. I think there are definitely alternative ways that the parties could agree to structure the way that the PPP loan is going to be dealt with. But these are the most common things that we've seen so far. And I think in particular, in light of the fact that buyers are not interested in taking on significant amounts of risk related to these loans, it's going to be, I think it will continue to be common to see things dealt with this way. So the next thing I'm going to talk a little bit about are required consents from your lender, the PPP lender, and required consents from the SBA. This has been another major deal consideration, and I think it's one that many sellers are not prepared for, and they haven't anticipated that that required consents in connection with these loans would be an issue in a deal. Until recently, we didn't have definitive guidance on this, but the SBA came out just last week with specific guidance about change of control transactions and what kind of consents are going to be required. Our team at Tonkon published a client alert last week that goes into all of the specifics. There are quite a few details there, and it's worth digging into. That alert is available on our website at tonkon.com. But for purposes of this presentation, I am primarily going to focus on the sale of an M&A transaction, the sale of 100% of your business. So under the new guidance, a seller who's looking to sell its entire business, whether that's in a stock deal or in an asset deal, would be required to get consent to that transaction from its lender, from the lender of its PPP loan, and from the SBA, unless certain conditions are met. And I just want to step back for a second and talk a little bit about what that means from a practical perspective. So if you needed to go get consent to a transaction from both your PPP lender and the SBA, that could create a significant timing concern. The SBA has 60 days to respond to any request for a consent to a transaction. And the requirements also require a fair amount of documentation to be submitted to the SBA in connection with that consent. So obviously, that's going to put a a significant delay in potential timing on any deal timeline. And I think everyone on this call could tell you that time is the enemy. A delay is the enemy of every deal. So that's going to be really significant. So in order to avoid being subject to the SBA consent, there is an opportunity that the buyer and the seller can agree to put the amount of the PPP loan into an interest-bearing account, and go ahead and submit your forgiveness application. And that escrow arrangement needs to be set up in a way so that if the loan is not forgiven, any amount of the loan that is not forgiven is first paid back to the bank, and then the rest can be released as the parties agree. So if you use this escrow arrangement, you don't have to go and get SBA consent. And I think that will be one of the significant tools that folks are going to try to use to make sure that they are not dealing with these timing delays. The other thing that I want to point out about this, though, is just that would mean that your forgiveness application has to be submitted. And at this point, some PPP borrowers are in a position where their banks aren't even accepting the loan applications yet. So that's going to be significant. So I'm just going to touch very quickly on two other issues, and that is buyer diligence on your PPP loan and what you should expect to see on PPP in the purchase agreement. With respect to diligence, buyers should expect, or sellers should expect buyers to conduct pretty considerable diligence on their loans. They're going to be interested in whether you are actually eligible for the loan, your necessity certification, how you use the funds, and any reductions in forgiveness that you might be subject to. And sellers can prepare for this by keeping meticulous records, or if a seller hasn't done that so far, go back and get those records in order before the diligence process gets started. And I think that'll make your life much easier. We're also starting to see standard reps and warranties in purchase agreements. And the same topics are going to be covered in the purchase agreement. We're going to be asking sellers to make reps and warranties on eligibility, necessity, use of proceeds, and they're going to want to know that all of the information that you submitted was true and accurate. So with that, I would just say that the key takeaways for sellers who have PPP loans are just to keep in mind that we're going to have negotiated deal points on your PPP loans. You need to understand what consents are going to be required and what that is going to mean for your timeline. Really encourage folks to talk with their PPP lenders early in the process, get this process started, and also be prepared for buyer diligence on your loan, and to deal with the loan in the purchase agreement in the actual document. So I think that's what we're going to expect to see on PPP in M&A, and happy to take any questions towards the end. Back to you, Cheryl.
Thanks, Drea. M&A transactions are already complex, and this just adds a whole nother aspect to it that sellers need to be prepared for. But thank you for that. So we will turn next to our last panelist. It'll be Tim, who is in our bankruptcy department at Tonkon, and he's going to discuss bankruptcy options for a seller. So Tim, why would a seller even consider bankruptcy as an option for an M&A transaction?
So bankruptcy has a lot of benefits for a seller who's in a distressed situation. In fact, it's become a very popular option over the last 4 years. I think the last statistics I saw were that close to 50% of all Chapter 11s are now sale Chapter 11s. So as opposed to your reorganization where the ownership stays the same and you just restructure the debt, they're now actually mostly done for sale reasons. And there's good reason for that, because the bankruptcy code has a section, we call it 363, that allows you to sell assets free and clear of liens, and it lets you to do it quickly and efficiently, and you can cut through a lot of the problems that might arise outside of a bankruptcy. And that could be particularly relevant in, our COVID world. Bankruptcy is also beneficial because it can attract additional buyers who might be interested in distressed assets. And it can even increase the price you receive for an asset, because as I'll talk about, it can result in an auction process. And if you get a bidding war going, you can drive up the price. So let's just take a quick look at a few of the specific advantages of the bankruptcy sale process. There's too many to really go into in detail here. I just want to hit on a couple of them. One is the preservation of value. A lot of distressed businesses are getting hammered by their creditors, by their lenders, by their trade suppliers, by their landlord, all over the place. They could be embroiled in litigation. They could have labor and employment issues related to COVID or other things. So it's very difficult to be engaging in a sale process when at the same time you're dealing with all those business distractions. Bankruptcy helps that. It allows you to have an automatic stay put in place the moment you file bankruptcy. So all those things stop. Collection calls stop, claims stop, litigation stop, landlords can't evict you, lenders can't foreclose on you. It puts a pause on all of that and gives you the breathing room that you'll need as a business to actually concentrate on the sale process. So that's one of the big advantages of a Chapter 11 for a distressed business. Another one is it can get rid of all the third party or counterparty consents that you need. So, as Claire, Andrea, and Brian were talking about, you need consents of these third parties, whether they're landlords for signing leases over, or they're your lender because they're going to transfer part of the loan, or they're even shareholder consents at times you need. You don't have to get those consents in bankruptcy. And again, in the COVID world, it may be hard to sit down and get meetings with those folks to explain what you're doing in order for those consents to be received, or even may not be able to find the people at all. So bankruptcy is a good solution in that, because the Bankruptcy Code 363 allows you to sell those assets without having to get those consents. And it does that because you send out a notice to all creditors and interested parties, and that notice gives people basically 21 days to come in and object. And that's all the notice they get. If they don't object, and the court, quite frankly, won't even find any objection viable in most cases, there's no reason for them to object, then you don't have to worry about their consent. It's deemed to have been consented. The Bankruptcy Code also has an advantage that even if you have a contract that says that they can withhold their consent, bankruptcy law trumps that. It overrules that, and basically you can still close a transaction and assign a contract over to the buyer, even if the contract itself says you can't, except in very limited circumstances. It's usually like a personal service contract or a government contract. But that can be a real benefit to a seller because it allows you to engage in a transaction that you might not have been otherwise. And the bankruptcy courts, by the way, are very friendly. They're eager to help the debtors. They're helping sales get through the process and the pipeline as quickly as possible. Another advantage of bankruptcy is that you can become more attractive to buyers. At the end of a sale in a bankruptcy process, you give title to the buyer free and clear of all liens, claims, interest, and encumbrances of any kind. And that is very attractive to buyers. You can't give a buyer a better title than an order from a federal judge saying, these are your assets, don't worry about it. It helps not having to worry about representation and warranty negotiations and a number of other terms that you really end up litigating or negotiating in detail with. You don't have to worry about that. So that makes you more attractive to buyers. If there's a dispute over who's going to get some money, that dispute doesn't have to hold up your sale. In bankruptcy, you close the sale and then the proceeds are impressed with all those disputes, and those are decided later. So to the extent somebody's trying to hold you hostage because they say, I want more money than you're willing to give them, a bankruptcy avoids that problem and just allows you to close the deal, sell the transaction, and then let the proceeds be what gets fought over later on. It also is beneficial because it allows your buyer to cherry pick what contracts they want. We call it assumption and rejection. So the contracts that the buyer wants, you can assume those and then assign them over to the buyer. The contracts that they don't want, could be leases, could be anything, those get terminated and rejected. And that's a benefit because then again, to the extent somebody's fighting about how much they're entitled to, that gets left behind. It doesn't complicate the sale itself. And there is an advantage in bankruptcy if you're shedding leases. There's been a lot of retail bankruptcies filed lately because they're shedding leases. The reason that works is because you can cap the amount a landlord is entitled to as a damage claim in a bankruptcy context. So outside of bankruptcy, you're going to have to either negotiate with your landlord that you're leaving and pay him in full, or hopefully a negotiated discount. In bankruptcy, you get the cap, and there's a formula upon which you cap that. I won't go into what the formula is. Another advantage is that you can increase your sales price and attract additional buyers. So bankruptcy is a public process. You will get publicity from the bankruptcy filing, and when you file your notice of intent to sell, that will also generate publicity. And the way the process works is you enter into an asset purchase agreement, or sometimes you aren't even that far along, you enter into a term sheet, and then you embark on a notice period. It has to be a minimum of 21 days. During that notice period, the buyer is still doing their due diligence, but you are entitled to still market the property and bring in other buyers. And then there's a deadline set by which other bidders can come in and make an overbid. And so during that time period when everybody's finishing up their due diligence, they're also determining whether or not other buyers are going to come in and make an overbid. If somebody makes an overbid, you have an auction. Usually it's within a week of the overbid due date. The next day, you'd have the sale and in front of the judge. The judge would approve the sale, and you can close within a day or two after that. So it's a quick and efficient process. And I can tell you that I've been involved in a number of these where you get a very low ball initial offer, and it's not something you want to take, but by the time you're done with the process, you can find another counterparty to bid. And if you can get two people in a room in a bidding war, there's nothing better. And it's even better if they don't like each other. That's the best type of auction ever. And we've had a few of those. So I won't go into all the other ones, but the timing for 363 sales in bankruptcy can be quick and efficient. The actual statute says 21 days. Reality is it takes, plus or minus 60 days, but it lets you to cut a lot of corners, move through the process quickly, and it's a good remedy for what I call the melting ice cubes, which are the companies that are losing value as each day goes on if you don't get to it quickly. And like I said, the bankruptcy courts are very eager to help. And it's a pretty efficient process. So thanks a lot. Back to you, Cheryl.
Thanks, Tim. Seems like there are quite a few reasons a seller might want to consider bankruptcy as an option, including increased valuation, which is, sort of counterintuitive when you think of bankruptcy. So that's good to learn. So with that, I want to summarize a few takeaways that I took from the presentations overall. Generally, that these kinds of transactions are going to involve a higher degree of difficulty right now, which will result in higher transaction costs, and that advanced preparation is key before entering into one of these. And then clearly a seller needs experienced M&A advisors like the ones we're presenting today. And if any of you have questions that we don't get to today, feel free to reach out to them. We'll include everybody's contact information in the follow-up email following this presentation. So we have about a little less than 5 minutes for some Q&A. I've got a few questions that I've written down that have come up. So Tim, I'm going to ask you one since you were the last presenter. As a small business owner, I have a couple of loans, one of which I have personally guaranteed. What happens to my personal guarantee if I decide to put my business through a bankruptcy sale?
Yeah, so bankruptcy of the company will not protect your personal guarantee liability. What generally happens is that the lender, however, will not go after the guarantee while you're in the bankruptcy process. So if the end result of that process is a way to either restructure that debt and term it out and pay it in full, or to have a sale where it pays it in full, then you'll be okay. However, to the extent that there's a shortfall to the lender, that will not protect you individually. Often we do, in that case, the individual would end up having to file their own restructuring bankruptcy after the company finished its. Cheryl.
Thank you. So the next one I'm going to ask Drea. Regarding the PPP loan approval process in an M&A transaction, you talked about the lender approval and the SBA approval. And you said there are a lot of documentation needs to submit for that approval. Does that include the definitive agreement itself? Because, as you know, that takes some time to negotiate. Is anything like that required when you submit it to the SBA for approval?
Yeah, actually, the definitive agreement, I'm not sure if it actually has to, if you actually have to submit the fully negotiated agreement, but you do have to submit a letter of intent as a part of that process.
Okay, so if it's just the LOI, it may not add on a significant time, but if they maybe ask for the agreement, then obviously it would take more time. I'm going to do one more question to Claire and then one to Brian. Claire, you talked about the risk allocation and the risk sharing in terms of M&A transactions. Can you talk a little bit about representation and warranty insurance? Because that's something that people hear in the market that can help minimize the risk to the seller when they are being allocated additional risk in a deal.
Yeah, absolutely. So that's a really good point. Our rep and warranty insurance is a good way to push the risk to a third party entirely. The risk that there's a problem with one of the representations in the purchase agreement being untrue. So instead of carving it out and leaving it with the seller, you could basically pay someone to take on the risk that there's a problem. The rep and warranty insurance has even before the pandemic was becoming really popular. The disadvantage is that now you've got a whole nother party and their legal team who are also engaging in due diligence, and the insurer will have different concerns and questions than the buyer in most cases. So you're providing more information, more follow-up, and also it costs money. There is a cost associated with obtaining this rep and warranty insurance over and above the increased transaction costs. So for most small deals, it just doesn't pencil. It just doesn't make sense to get it. But it does potentially give the sellers a lot of comfort, which is its own value that might make it worth it even for deals on the smaller side.
Thank you, Claire. The last question will be for Brian. Brian, you're doing M&A transaction these days, and I know that they've got PPP loans in them. Can you tell us on a practical level how you see the PPP loans impacting the deals that you're working on?
Yeah, sure. I think Drea and Claire mentioned how they add a complexity in terms of approval and timing, but in terms of valuation and interest from investors, I'd say it's net neutral. If a PPP loan hasn't been forgiven yet, there's really no P&L or income statement impact. Once it is forgiven, it would become part of the net income or EBITDA. Buyers would strip that out as one time or non-reoccurring. So from an investor standpoint, assuming you can get the logistics worked out around the forgiveness or the liability or the escrow with the SBA, it really has no impact on valuation or investor interest received.
Great. Well, with that, we've come to the end of our hour. I hope that you found the session valuable and invite you to watch for additional webinars planned in the coming weeks. Thanks again for joining and have a great day.